Okay, Kate, do you have another speaker for me?
Yeah, I've got Erik Gebhard.
Erik, how you doing?
Hey there, John. I'm doing great. Hope you can hear me okay.
Oh yeah, loud and clear. Where are you broadcasting from today?
I'm at home in my office here in Laguna Niguel, Orange County.
Oh, great. Good old Orange County, but the
Yep.
beaches are gorgeous this time of the year. Okay, go ahead
Uh,
and get your PowerPoint
yep.
up. After several years, Altavest developed a large client base of options traders. The Altavest team saw a need to make complex option spreads simple. They then developed the Theta Trader, which pre-selects complex multi-leg option trades on stock indexes and automatically manages risk and reward. The Theta Trader technology allowed for the creation of a unique six-leg option spread structure called Dragonfly. The Theta Trader also utilizes an integrated trade alert functionality where, and to respond to an alert, the client only needs to touch accept or reject on their smart device. Mr. Gebhard also worked to make automated futures trading systems available to Altavest clients via a user-friendly platform called AV Systems. The purely algorithmic-driven systems on the AV Systems platform, as well as unique option strategies, offer non-correlated investment opportunities. Mr. Gebhard enjoys spending time with family on adventurous outings along with vintage automobiles, bike riding, and church activities. He also volunteers as a member of the Dean's Advisory Council for La Sierra University's Zapara School of Business. Okay, I will be, Erik, you have until 5 minutes before the hour when we hand out our next batch of prizes. I'm going to go ahead and mute myself and you have the floor.
Yep. Very good. Thank you, John. And hopefully I can also get a 9 out of 10. That's a hard act to follow. But thanks for joining us and joining me, everyone. We're going to talk about automatically trading options using algorithms to help us along the way. We have a proprietary methodology and software that's going to be demonstrated in just a bit. We're going to look at some strategies that you probably haven't seen, and also one of the most overlooked stock indexes that we need to be trading. I'll show you more about that. You won't need to screen watch or be glued to your chair to do this because we're going to use automation to help select and manage trades. And with that said, do take a look at that risk disclosure before we get started. The main thing would be to always use risk capital when you're speculating, and past performance is not a guarantee of future results. Remember, speculators, of course, accept risk, and we're speculating, hoping to make money, but of course, there's always risk involved when we are speculating. And a little bit about Altavest. We've been doing this since 1997 as a registered introducing brokerage firm for 27 years, having traded tens and tens of millions of contracts along the way. We are on the trading floor, the S&P 500 options trading pit with some of our floor traders here. And that's yours truly there in the middle. And that really doesn't exist any longer. And we're going to talk a bit about that because the machines have taken over, sort of like in Terminator. And we created the Dragonfly option strategy and also proprietary order execution technology. And we're going to show you a little bit more about that. And of course, we're members with the NFA, registered with the CFTC, and we're located in California. I've been doing this for about 33 years now. My name is Erik Gebhard, co-founder of Altavest. I was licensed back in 1991. I have my business degree from the University of Southern California. And I was in the securities industry with my Series 6 and 63 licenses with mutual funds and annuities. Also had my Series 3 license way back when, and also my Series 65. That's current. That's the investment advisor law exam is what they call that. Basically, you can be an RIA, a registered investment advisor, with that license. Okay, so we've got the introductions out of the way. We're going to look at these top 3 barriers that we've kind of put together. We'll go through this quickly, but based on feedback over the years, we've kind of narrowed it down to these top three. A lot of noise, conflicting price targets, opinions, narratives, too many choices. And here's just one example on a trade, just one: options, expiration, and all the different strike prices available at all the different pricing. And there's, literally millions of daily combinations of options trades available day by day. So how would you know where to begin? And how about price predictions? You hear in the media, everyone has a target or a price prediction. And this one I've used it for like a year now, and you'll see why. Here's a guy on CNBC. He says Bitcoin is either going to 250,000 or 5,000 next year. And so that was in December of 2022, a year and a half ago. And of course it didn't happen, but not to criticize him in particular, but I don't even know, why would this even make headlines? I think it's just a lot of clickbait, really. I mean, how valuable is that information? So what would you do with that information if you were reading that or watching him say that? Are you bullish? Are you bearish? I don't know. Anyway, here's some price targets from some of the big firms here. Year-end 2024 S&P 500, and S&P is above all of them at the moment. So at the moment, they're all wrong by quite a bit. But again, who would you listen to? Just a lot to filter through. How about the second barrier? We can probably relate to this. How about time? Just very simply put, time. We only have so much time in a day, so I don't think we want to be glued to our screens all day like this poor guy here. And then the third barrier is really us, our own emotions. We get into our own heads, as the phrase goes. We ride that emotional roller coaster. Here's what it might look like: is you're making lots of money. That's kind of the point of maximum risk, really, because we tend to get overconfident at times. And I noticed, I saw a bit of John's presentation just prior. He talked about some of the trades. You have your entry price, but also you have to have your exit price too. You got to know when to get out as well. But then here we go. As you pull back, you start to get depressed, and usually that actually turns out to be the point of maximum opportunity. So tough to follow our emotions when you're trading. That's probably not a winning strategy. So we need to do what he's telling us to do, folks: control our emotions. And it's because our emotions, and we just cannot compete with algorithms and machines and high frequency trading. And you're going to take a look here now at your competition with no emotion, automation, built-in controls. JP Morgan estimates 90% of the US equity trading volume is systematic. So that's all machine driven. Becoming more and more algo, or at least, or I was going to say more and more AI driven. So that's what we're competing against. So we're going to look at using algorithms for professional style option spreads and options trades. So that's what we're going to jump into in just a second. And before we do that, let's look at how options are traded. If you were a large institution, kind of the same theme as an insurance company might be trading. If they were trading options, they'd probably apply the same strategy they use now, which is they get paid premiums to assume risk. They're selling and managing time. They insure themselves by hedging every position, and they're consistent, and they're patient, and they have a process. I should probably highlight that word, process. And probabilities, another word to highlight. They look at the long-term odds and whether or not these odds are favorable, mathematically speaking. And they look at statistics. You're familiar with the term actuarials. So whether it's automotive or life insurance or what have you, it's really number crunching. And we can collect premium too. We can kind of take the role as an insurance company does by collecting option premium. Lots of base hits where we're selling options and collecting the premium from the people who buy the options from us. So we're going to have a process to be consistent and patient, manage risk along the way, knowing that we will have losing trades. Manage reward as well. You don't want to overstay your welcome. You'll need some experienced coaches to give you some guidance along the way. And then you need the correct tools to make this happen. Again, lots of base hits, and we're not swinging for the grand slam in these types of strategies. These are short option strategies for collecting premium, and they can be any one of these three. They can be non-directional, bullish, or bearish. And when I say non-directional, I'll show you what I mean. We're going to target outcomes with fixed risk. So you're going to know the maximum risk before you get into the trade. So these are called credit spreads, where you collect premium and receive that credit. Every position is insured or covered, and every risk reward element is predetermined in advance. And they can also be non-directional, as I mentioned. But before we jump into that, two terms we need to know. Options, you know, they have their own language, and they call them the Greeks. They use Greek letters of the alphabet to describe some of the character traits of options and how they react and so forth. But we're going to look at just two. They can get really, really into the weeds with the Greeks, but we don't need to. We're going to look at delta. And what that is, it's the option value. How much does it change with a change in the underlying index, or in this case, underlying index or asset? And it's also the approximate probability of expiring in the money. So you might be thinking, what on earth is he talking about? Well, let me show you. If an option delta is 0.25, that means there's a 25% chance that it will expire in the money, according to the math. But conversely, there's a 75% it would expire worthless or out of the money. Remember, delta here is not static. It's not just a number that sits there. It's always moving with price and time of the asset and so forth. And then it is not the probability of a winning trade as well, so don't confuse it for that. And then there's theta. So you've got time decay, and that's what theta represents, because every option does have a limited lifespan. It's a wasting asset is what they call it. So it has an expiration date, and theta is a negative number equaling 1 day of time decay. So if an option's at 10 points and theta is negative 0.05, that means the next day the premium will drop to 9.95, and after that 9.90, and so on and so forth, all things remaining equal. That's just focusing on the theta decay. And here's what it would look like on a graph. So as you see, you approach time zero, the percent of the premium drops and drops and drops eventually to zero, because there's no time left. So Wall Street pros trade option spreads, multi-leg option spreads to collect premium. And here's this woman interviewed on CNBC. She says an option spread is the buying and selling of different contracts. Very common way for investors to hedge risk and volatility, usually cheaper because you can offset your cost by the proceeds from different contracts. I heard John even mention just a moment ago about an option spread they had traded, so he knows exactly what I'm talking about. I think it was a TLT, if I recall, but anyway, it doesn't matter. But anyway, option spreads have been used by Wall Street professionals for decades. And this made me laugh when I saw this, so I threw it in here. May the odds be ever in your favor. So that's what we're talking about. We're going to try to trade like a Wall Street pro with option spreads, selling and collecting premium. And we're going to use automation to help us collect option premium, whether it's a bullish or bearish or non-directional setup. And here's an example, selling an E-mini S&P 500 call spread. And I'll tell you a little bit later why we look at E-minis. But for now, this is a bearish setup or moderately bullish or non-directional. And here's what it looks like on a graph. You can see the price of the index here moving around, and you can see the expiration date here of this particular option spread. So you sell the 5640 call, that's the red line, and you receive 4.5 points. Put that in your pocket. But at the same time, you buy the 5660 call, and you have to pay 2.25, and that's the blue line. But the net result is you collect 2.25 points, $112.50, minus commissions, of course. And the idea is you look for the market to sort of basically just chop around and stay well below this red line here, below the spread that you've sold. So it can go a little bit higher, can go sideways, or it could even drop, and this trade would more than likely be profitable. And then here's the opposite with a put spread. Again, your setup has various elements and where it will work. In this case, bullish, moderately bearish, or non-directional. It's better to look at it on a graph. So you sell this out of the money put spread, that's the red line. You collect 3 points, and then at the same time you buy the blue line, which is the 48.30 put. You pay a point for that. That's your hedge or your protection or insurance. So the net result is you collect $100 minus any commissions. And again, you look for the market to stay essentially as far away from this area, and over time theta decay will work, and the amount of money you received will diminish and diminish, where you can then buy the spread back for a lower price than what you receive for it. So these are not naked positions. Remember, everything is covered. So actually, I saw there's a lot of cats online, right? Everyone puts photos and videos of their cats on the internet, and there's a couple I saw that have a couple of Sphinx cats. And I don't know, I always crack up with these guys, but they look like aliens to me. But no fur, they're definitely naked, but we're not trading naked options. If you're doing naked options, I would stop doing it, because it might work for a period of time and work very well, and you might feel kind of impervious to taking a loss at some point, but it will blow up at some point. So that's my advice. Do not trade naked options. These are only covered spreads, not unlimited risk. And the big benefit too is no margin calls. That way you won't be forced out of positions when you're doing covered spreads. Here's a joke here. This woman says, who is Margin and why does she keep calling you? She's looking at his phone apparently. Then here's an iron condor spread, and this is a non-directional strategy, and it's just a combination of the put spread and the call spread that we saw. And this is what it looks like on a graph. You sell an out of the money call spread, and you sell an out of the money put spread, and you do that simultaneously. And the net result is you collect premium on the put side of the trade and the call side of the trade. And then here's the idea: is the market kind of goes back and forth in between these two thresholds here, the calls and the puts. And then of course, every option that's short, you have a long option, no matter what the quantity is. So these are covered positions. And an iron condor really has a non-directional bias. And why would you even do that? Well, because theta decay. So the idea is, here's that trade. You've sold this condor spread, and as time goes by, in this example, see this arrow, this is where we get a signal to close out the position and buy it back. So you sold it for a certain amount of money, put that in your pocket, and then you buy it back for less money than what you received for it, and you close the trade out. And I'll show you how we can do this with automation. And that's the idea behind any one of these types of short option strategies. You sell it first and then you buy it back later for less than what you received. And here's our proprietary strategy. It has 6 legs. We call it a dragonfly. And it's a variation on the condor. And here's what it looks like. It might look a little bit complex, but let's just focus on the calls up here. You sell 4 calls, you buy 3 further out of the money, and then 1 closer to the money call. And then for the puts, it's the same structure. You sell 4 puts, you buy 3 further out of the money, and then 1 closer to the money put, and you receive premium. The net result is you receive premium on the put side and the call side, and then you put that in your pocket. And then after theta decay works its magic, here's what it would look like in the case of a winning trade. You can see the market in this case dropped, and then it went back up, but ultimately stayed well within the parameters, this wide margin of error here. And then you had a signal to buy the spread back right here, well before expiration. Looks to me like May 5, and this is expiration on May 31st. So you have this blue signal here to close out that trade. So then you buy it back for less than what you received. I want to talk real quickly about the E-mini S&P 500, or just the S&P 500 stock index. It's really not as diversified as you might think. Maybe at one time it was, but right now it is not. You've got big tech, Apple, Amazon, Microsoft, Google, NVIDIA. They account for most of the S&P's 11% year-to-date gain. So really it should be called the S&P, 5 right now. So it's really here's what it looks like on the graph. You've got those 5 companies here, 27% return year to date, while the S&P without them is only up 6%. So very interesting. Here's another graph of it. 55% of the year-to-date return on the S&P is from 4 stocks. So you've got Meta, Amazon, Microsoft, and Nvidia. And then this lastly here, the S&P is the most concentrated since 1964. So the current top 5 here, this red bar here, represent looks like about 24% of the index. So it's a market cap weighted index, meaning the bigger companies have more influence on the index price. And then here's a equal weight S&P versus S&P 500. And I scribbled this green line here. The equal weight S&P 500 has actually been dropping in the last month, while the S&P 500 itself has been making new highs. And of course, that's because of stocks like Nvidia and Apple and Meta, and Google, Microsoft, essentially. So if you're not in those big 5 companies, you're probably not benefiting a whole lot. And then here's the E-mini, the Russell 2000 index, and that's a small cap index, and so there's no big tech in that index. And here's what it looks like compared to the S&P. You can see since March, actually, the Russell is declining, while the S&P and NASDAQ, for example, are making new all-time highs. So we're going to look at that and why we kind of like having exposure to something like the Russell as well as the S&P. But of course, you saw the strategies we looked at. They can be tailored for any kind of environment. So we're going to show you in just a second. And look at this, the Russell Q1 2024 earnings as of, I think, just, well, the last figure I have was May 23. Year over year growth, they're actually negative. So completely different environment outside of the S&P or the NASDAQ with the handful of those big tech stocks. So we have unique bearish and bullish option strategies. You don't have to be non-directional. But how would you even know where to begin, which market to apply any of these strategies to? Are you buying? Are you selling? What's the correct price or the entry? And how do you manage the risk and the profits? In other words, where do you get out? So these are questions that ThetaTrader solves, and that's the proprietary software. It's pre-built option spreads. The proprietary algo will generate these theta trades each day, these professional option strategies, these spread strategies for any market condition with the automated risk and profit tracking, something called the RTI, or the risk thermal indicator, and that's proprietary to ThetaTrader, and it's color coded. So we're going to jump into the demo right now. Just give me one moment to switch screens. If this all goes well, you'll see the ThetaTrader dashboard. Okay, so now you're looking at the ThetaTrader dashboard, and you can see this is my demo account for doing presentations and so forth. And you'll notice the top section here are the theta trades. And then these are your open short positions here, or short spreads, open long or bought spreads. And this is all the account information pulled from your trading account. So everything is integrated with your Altavest trading account, then any current price quotes. And we'll jump into some of the details right below, but first we'll just start up here at the theta trades. You'll see there are bullish strategies that are pre-populated, bearish and non-directional or neutral. And you can apply these to the E-mini S&P 500, E-mini NASDAQ 100, and the Russell 2000. And so the first thing I like to do is, since we've talked about the Condor and the Dragonfly, we'll look at a S&P 500 mini Condor, and here are all the theta trades from today, anywhere from 16 to 56 days till expiration. And you can see that, well, we'll just look at this one here. The July end of month expiration, it chose the 50-20 put and the 57-40 calls are the ones to be sold. You have a maximum profit potential here and your targeted annualized return at expiration. That's called the TAR. And that's really to compare one of these condors to another. And you can see that really the TAR is almost always going to be higher because on the trade that has a fewer days till expiration. So that makes sense, but really to compare one trade to another, not to expect that if you place this trade, you'll magically get 69% a year all the time. But we'll go ahead and drill down on this. And let's look at the details of this trade. Okay, so this is the table with all the details. First thing I like to do is look at a graph. So here's the current price. Here's the call spread you're selling and the put spread you're selling. And this is done simultaneously with one order at one price. You don't want to leg in. Would not recommend it. And you can see 56 days till expiration, the settlement price, the premium that's being collected, put risk, call risk, commission, capital available, cash required, profit potential, targeted return on cash, and then targeted annualized return. And here are the puts and the calls that are being sold, and then the put and the call that is being bought as a hedge or to cover the position. Let's look at the put here first. Selling the 50-20 put, that has a delta of 9.8%. So what that means mathematically is there's over a 90% probability that this put that's being sold will expire out of the money. And look at the call here, 6.87. So that's over a 93% probability that this call that's being sold will expire out of the money. And that's why I guess the algorithm chose those particular strikes, looking at the higher probability outcome of expiring out of the money. And you could modify the strikes if you wanted and change them, but that sort of defeats the purpose of having the algorithm build the trade for you. Now you're selling the condor, meaning collecting the premium. So it always defaults to a sell and it always defaults to a quantity of 1. But you can see here, if you raise the quantity, in fact, let me just go back real quickly. You'll notice $903.50 required to hold the trade, and then your maximum profit potential $96.50. So sometimes people will say, well, that seems odd. I don't want to put up 900 to make 100. Well, keep in mind, that's the whole idea of these types of trades where the deltas are mathematically in your favor. So you have a higher probability outcome that these options you're selling will expire out of the money. So that's the trade-off. Okay, so then maybe we'll do 5 of these and we'll place the order and we'll show you how simple that is and just assumes you're filled in this demo account. And we'll go back. And that means the order is placed. And then we'll jump in and we're going to look at a dragonfly in just a second. Sure, taking its sweet time here, folks. Sorry, I don't know. Sometimes on the webinars it does that for some reason. I don't know why. Give it just another minute, and if not, we'll refresh. And if it still gets a little glitchy, I'll come back to it and I'll show you something else in the meantime. All right, so we'll look at a dragonfly. And this is the August week 3 expiration. It has 72 days till expiration. And you'll notice right away the dragonfly has a lower targeted annualized return. You can see it's at 35%. And the reason why, and that's typically going to be the case, is because the dragonfly, let me explain that to you here. When you sell these 4 calls and you buy these 3 further out of the money calls, you buy another call closer to the money. So you actually pay money to own this call that's closer to the money by 50 points. So that's an additional insurance or basically premium that you pay to make this trade a bit more risk averse compared to a condor. And it's the same thing here with the puts. You buy this one put and it's 50 points closer to the money in this case. And so that's an additional cost to essentially insure the position a bit and create a more of a hedge against a loss. It doesn't mean the trade can't lose. It just means it's a slightly more risk averse trade. And therefore, because of that, you have less to gain. And you'll notice the cash required here, 4,600. That's because you're selling in quantities of 4 puts and 4 calls. Your profit potential maximum at expiration is 323. And you'll notice the put in this case that's being sold 9.79 delta, and the call that's being sold 6.38 delta. So again, over 90% and 93% probability that the puts and the calls will expire out of the money. And it always defaults to a sell. Again, just like the condor, you're selling the dragonfly, attempting to collect premium, always defaults to a quantity of 1. Why don't we just jump in and do 2 of these? We'll leave the pricing. We'll try to get over just over 8 points here. And we'll place that order for you. And there you go. So you've placed your order, and then you just wait to see if it gets filled or not during the day. Okay, now what I can do now is you'll notice under trading, there's a menu for simulator. So we have a back testing engine, kind of a time machine as I like to call it. And you can go backwards in time. And let me go ahead and zoom out just a little so you can see the whole screen. And you can test trades and see how they would have played out. So here's from April 26 on Iron Condor. And you can use these buttons to play. And you can see the RTI is green. That means good, do nothing. See, the trade is turning profitable. That's because of theta decay. Then it turns yellow, so elevated risk, and then it turns red. So you end up taking a loss on this trade because you can take the red RTI and the algorithm says too much risk, get out of the trade. And so in this particular case, you end up with a loss on this trade if you follow the red RTI. And that was on June 15th. Now let's compare that to a dragonfly. So this is the same expiration. Instead of doing a condor, maybe you did a dragonfly. And look at that. You had a profit-taking signal on that day. So that's the difference that we kind of pointed out just a bit ago about the dragonfly compared to the condor. You own this call right here. And so the delta is higher on this call. And as the market was moving closer towards it, it was actually gaining in value at a faster rate than the delta on the further out of the money calls that you sold. And so that acted as a hedge, and it allowed the trade to mature more quickly and reach a level of profitability where the algorithm said, get out and take your money and run. So you can see here, in taking the end of month June expiration on the condor, the end of month June expiration on the dragonfly was more robust and more risk averse. So I just wanted to point out the difference really in those trades. And here's another one. It's a January end of month. And then you can see the condor ends up with a losing position as well. Oop, and now let's check out the dragonfly. And you end up with a profit-taking signal. So I want to point out also that you can automate this. So whenever it turns blue for a profit or red for too much risk, Theta Trader will scan your account and it will automatically place that order for you. So I'll show you how to do that. And that's really one of the automation tools that we talked about and referenced earlier. Okay, here's a trade here, a condor, a March into month expiration. I kind of forget actually what happens on these. I just kind of chose them right before the presentation. Okay, so this takes a profit here on March 25th with 4 days till expiration. And the way the algorithm works is it's basically almost always going to get out before expiration, whether it's for a blue profit or a red too much risk. You can see this vertical line is the expiration date. So you ended up with a profitable trade on that condor with 4 days till expiration, which, okay, fine, good enough. However, what if you did the dragonfly on that same day for the same March into month expiration? So that trade actually matured enough and had a profit signal on March 15 with 14 days till expiration. So basically, 10 days earlier, you could get out of this dragonfly compared to the condor. So you had to stay in the condor for an extra 10 days or so compared to the dragonfly trade. So that's what I kind of mentioned earlier. Sometimes a dragonfly will allow you to get out of a trade earlier compared to a condor, or it will actually generate a profit signal when the condor does not. So that's why we really like the dragonflies. Now I want to show you how to go ahead and you go to my account, my settings, and here's the page that you get. And this is how you activate your automated risk manager and your automated profit directive. You just check this box here and check this box here, and then just save those settings. That's just that simple. So then the RTI will scan the account for you and then place those orders on your behalf. And then also I want to point out we do have proprietary research available. It's under my account. You'll see the trade scope here. And we do this every day for our clients. So it's analysis, whether it's technical and fundamental. We look at cycle analysis, money flows, option flow, you name it. It's in here. It's one page, pretty concise and I guess in one spot for you. And we also have something called our daily commentary, which is something our clients like as well, where they get to just review what happened during the day in just one simple page. So a summary of what happened in Europe and Asia and the US, and then looking ahead, what to expect, and then also what's on the economic calendar. And then here is a great help file as well. Under my account, you go to help, and you can pull down the glossary, and you can see all of the description here of the RTI and the color coding and how it works, and then definitions for all the different strategies and so forth. That's all available in the help file. And then also, these are all videos here. So internally speaking, you've got everything you need in terms of learning about options or brushing up on strategies, how to use the platform. If you have a little question or two, is always going to be answered in here. Some education. These are great training videos and so forth, all embedded within ThetaTrader. And then let me just magnify this a bit. I always get bugged when people have webinars and I can't see the screen. So hopefully I'm not doing that. Same thing. Now we talked about the Russell. So here's an example of a Russell position here. You've got the July week 3 pulled up, this one here, and you can see the targeted annualized return looks very robust on the Russell. And in part, that's because the volatility, the Russell volatility, I think it's actually higher by 5 or 6 points compared to the S&P or the VIX. And you've got the same kind of thing happening with the Russell, the Condor trade here. And we like the Russell now a lot, actually, just because the value is there. You can get over 2.5 points according to the, we'll do 4 of these. and place that order, and there you go. Just that simple. Now I want to show you also, before I move on, I think to the next step here and showing you, I think, what's the best feature of all. I do want to point out a couple things here on bullish and bearish strategies. So here we have all of the bullish strategies available on any given day, or bearish, because you don't always have to be non-directional. And perhaps you're looking at the NASDAQ. Here's something we call a bull hedge, but also you could simply, sell a put spread. You could buy a call spread. We don't always just or only just sell option premium. Here's an example of some long option spreads down here. But I want to point out the bull hedge. Perhaps we're still bullish on the NASDAQ. Here's a trade with 30 days till expiration. And I'll just show you what this means and how it works. For these demo purposes, I just randomly choose the trade with the most days till expiration. So this is what a bull hedge looks like. You essentially buy an out-of-the-money call spread. So you actually buy the spread, and then you sell an out-of-the-money put spread to pay for it or finance the purchase of it. So you can often do these at no cost or very low cost. So you're buying the spread. Maybe we'll do 3 of these and go ahead and place that trade. So just wanted to show you how easy it is to do something directional as well. And then if you wanted to take a review of any trade history, of course you can do that. You can look at your open positions on not only the dashboard here, but you can look at them on just one page altogether. I'll show you that here. These happen to be all green, which is good. Oops, let me just go this way so you can see the whole screen. Okay, so these would be open positions in your account. You can see a summary, total of 18 short positions, 4 long positions, and right now there's an open loss of about $300 on these short 18 positions, which is totally normal because theta decay takes time to work. So all the trades that you just saw me place, they're going to start off essentially in the red. Theta decay hasn't started to work yet, but RTI is green on all these, so that means do nothing. Even yellow, slightly elevated risk, but still do nothing. And if you wanted to take a look at any one of these trades, maybe you just click on this one here. You can go back in time and take a look at where everything was when you placed that trade. So there you go. This is what it looks like on May 17 with 29 days till expiration. And you can see day by day, trade has actually been gaining in profitability. It's probably very close to a signal here to close that out. I would guess maybe by even tomorrow. So also close positions, and then we'll move on to the next step and kind of wrap this up. And I should also point out that everything in ThetaTrader is calculated, all the percentages and dollar figures on your trade, everything is considered net of all trading cost. So you don't need to try to guess what the trading costs are. Everything's factored into the percentages and the dollar figures. But here are the trades, 20 closed positions on this trade, 13 winners, 7 losers. Here's your total loss on the page. Out of the 20 trades total, 13 were short option spreads, and 12 of those were winners and 1 loser. And that makes a lot of sense compared to the bought positions. You had only 1 winner and 6 losing trades. And that makes a lot of sense because, again, if you're selling options, with these deltas the way they are, and the algo is choosing the higher probability outcomes that will mathematically have a higher chance of expiring out of the money. So if you're selling those to someone else and collecting the premium, the odds are on your side, or like that meme says, forever in your favor. But so that makes a lot of sense. That's why we like to focus on premium collection. So I did want to point that out. And of course, there's more fun to be had with Theta Trader, but you can use the simulator, go back in time. You can build your own trades if you'd like. But for now, we're going to switch screens again, and I'm going to show you the best feature of all. And keep your questions and comments coming. I see some stuff in the chat. I just don't have a chance to look at it right yet. I may answer some of the questions as we go. We have the trade alerts. Those are 1 minute, one touch responsive alerts. You receive an alert on your phone or device or email. You touch accept or reject, and that's all you have to do. These alerts are live and integrated with your trading account with Altavest. And here's what it looks like. You'll get a text. In this case, you touch the text, it takes you to a page, give you a headline for the trade and explanation. You see the chart of the trade. Want to point out the premium being collected, the cash required, and then the quantity is already selected for you. In this case, 10. And that's every trade you receive is tailored and customized specific to your account. So you won't receive a quantity that's too big for you, and you won't receive a trade that's redundant with any existing strikes or expirations. So if you take a glance at that trade, you like the metrics, you just touch accept, and that's all you have to do. And then we handle the rest. So here's what to do, folks. If you like what you see, we'd love to have you join us and start using Theta Trader and become a member. Remember, we just looked at Theta Trader and all the software with the Theta Trades, the risk thermal indicator, the trade simulator. That software is valued at almost $3,600. Then we just saw a brief example of the trade alerts. People love the ease of use and the intuitive interface, and you don't have to log into another machine or system and try to take an alert and copy it down. So we automate that for you, that whole process where you just touch accept and you're done. It's out of your hands, and we place the order for you. And then, of course, if the order is filled, Theta Trader can track it automatically for you if you have the profit and risk directive selected. So you have the software, the alerts, $8,000 value. I think even just as important, you have us, Series 3 licensed traders to work with you, at least a $7,500 value. We're real people. We're doing this. We're around during the day. It's what we do. So you have access to us, and that's invaluable. So you have the software, the coaching, valued at over $15,000. Don't forget our proprietary research, valued at over $2,900, and that's only available to Theta Trader users. Those online video tutorials we looked at briefly. So everything added up over $18,500 value within the Theta Trader membership. Of course, we're not going to charge you that. This is how much we would charge before the pandemic. We do lots of live presentations. We travel all over the country and host meetings, and $4,000 become a Theta Trader member. And we have the table set up in the room, and people would sign up, the contracts and whatnot. But we've simplified it and made it much easier. And we like these presentations with John Thomas and the Mad Hedge Fund Trader Group. It's always a lot of fun doing this. We love being invited. So this is our Mad discounted price. It's only $597. Here's the simple order form page, and here is the link, cf.altavest.com/mad. And do take a screenshot or picture of this page. That's my direct phone number and my email. Call me anytime. Call right now, and someone will pick up, and we'll be glad to help you and answer any questions. And there's the link again. And there is a money back guarantee. If you get started with us and decide it's not for you, we'll just refund the money. So it's a risk-free opportunity for you to become a member and at least check us out. And if you want a free membership, if you have an account of $100,000 or more, we'll rebate the membership fee completely, 100%. If you have $50,000, we'll rebate that 50%. So people love to take us up on that offer, and we'd love to make it available. So a few FAQs. One thing, tax efficiency. Yes, it's tax efficient to trade futures options. You can lower your tax rate by over 10% because of it. I won't go through the math here, but essentially, if you take what we're trading compared to trading individual stock options, you have tax savings of over $2,000 in this example. And that's because 60% of the gains are taxed at the lower capital gains rate. And there's no more itemizing. And always consult your tax attorney or advisor. People have IRAs. Absolutely, we can do that. We do those all the time. And again, why the E-minis? I kind of mentioned that. I would get to it. Well, they're liquid, they're efficient, and they're cost effective. And the E-mini is actually huge. The E-mini futures trade 3 billion in notional per day, 10% greater than the notional value traded among the 500 underlying index constituents, and 10 times the value traded across S&P 500 ETFs. So what they're trying to say is this is where so much volume and liquidity occurs. And the CME is reporting record E-mini options volumes here. Average daily volume, 1.6.3 million contracts on the S&P 500. And the NASDAQ and Russell 2000 is growing a lot as well. So you have a large market share, densely packed strikes, 100 annual expirations. So you get that granularity and coverage. And what that means is you get superior execution, according to the CME group, a cost savings of $4 to $15 per contract compared to the SPX. So you get those tight bid offer spreads and deep liquidity, wide array of maturities. So that means our algorithm, when it's searching for the strike prices it needs, here's some puts and calls, it's going to find them. Here's another set of puts and calls, it'll find what it needs. And the Dragonfly with us, by the way, 6 legs, it's the only place I've seen where you can do it as one order at one price. Otherwise, if you want to do a Dragonfly elsewhere, you have to leg in with 2 separate spread orders and then break it up and leg out too. So very inefficient doing it that way. So these are sophisticated option strategies compared to the retail stock options traders. She says most retail investors only have access to the most basic call and put strategies. They don't have access to option spreads or other more sophisticated strategies. And she mentions here the pros are not options buyers. That's how rookies trade. If you're only buying options, then theta works against you. And here's her name here. I made sure to put that in there. It's a great little video she put together. The appeal for a lot of retail investors to buy options, they're much cheaper, but your potential for profit is not that high. In 2021, 11% of Robinhood active users made options trades, and fewer than 1% made multi-leg options trades. So advantages to trading the E-minis, basically, this is where the volume is, folks. And they trade at the CME group on the Globex electronic exchange. Every order is treated equally. There's no payment for order flow. There's none of that commission-free nonsense. And it turns out that orders are executed at inferior prices at these commission-free places anyway. So none of that with Altavest. Everything is transparent. 5 1/4 round turn all in. That's your rate on the E-minis. Here's a screenshot from a big box brokerage firm. They charge 2 1/4 per contract, but what they don't really clarify, that's only when you enter. Then you pay another 2 1/4 when you exit, and then they add exchange and clearing fees, and that ends up being higher than what we charge. So our rates are competitive, folks. Everything is net of trading costs. I mentioned that. Everyone trades differently because these are self-directed accounts. And yes, we do suggest a minimum 20,000. And then just to wrap it up here, why would you even consider something like Theta Trader and these strategies, alternative strategies? Well, they may improve diversification and lower portfolio risk. The risk of what exactly? Well, how about inflation for one thing? You've got this guy swimming with the inflation shark. I won't go into the details, but as you know, the price of everything is up, 50%, 100% when it comes to food in particular. But yet the government says, well, it's only up 21%. and this was interesting. Is the Federal Reserve just winging it? This is kind of interesting here. This guy analyzed the FOMC dot plots, and they only got interest rate projections correct 37% of the time. So I just threw that in there because you can't always believe the experts, folks. You just kind of have to go with your gut on things. So just to review, you've got all these non-directional strategies. You don't have to worry about trading the chop. You have a wide margin of error between the sold calls and puts. Time saver, you don't have to spend 10 to 20 hours a day or 12 hours a day. We think the diversification makes a lot of sense for you. And there is the MAD price. So just sign up. We'll get you started with that account. You'll start receiving alerts. You'll start receiving access to the account. You get the alerts here, the strategies, the demo trades. You can use the simulator, that time machine. And here's what it looks like. You get an email. So you get the alerts via email as well on your dashboard, on your phone. Just touch accept. And that's it, folks. I'm going to wrap it up unless I think maybe I have one more minute. In the Fed, that's pretty funny. Yeah. Yeah, that's the offer there. Yeah, commissions are 5.25% per contract, $20,000 minimum. And well, that's not in stone. I mean, if you have a little bit less, give us a ring. All right. Let me know what I can do for you. You've got my phone number here, my email. Let's get you started trading options the professional way. Thank you again, John and Kate, for having me. It's always fun to do this, and hopefully we'll see you soon.